guys, hope everyone's well. This video is one that I'm actually really looking forward to doing. It is one that I think will probably have a big impact on your trading if you're not already aware of this concept, because it's a different perspective, and perspective is everything. So new perspective brings new viewpoints, and yeah, I know when I kind of put this together, or when it clicked in my head more so, it definitely had a big shift in my trading. So yeah, let's get into it. So I wanted to start with this quote from Jesse Livermore saying that there's nothing new on Wall Street. There can't be, because speculation is as old as the hills. So basically just saying whatever has happened in the stock market has happened before and will continue to happen again. This doesn't just mean the stock market, obviously it means any market, so FX, crypto, stocks, obviously anything, commodities, etc. So Jesse Livermore, if you haven't heard of him, probably one of the most successful traders to ever live. And just this particular quote really hones in on exactly what this video is about. So what goes up must come down. Basically the same thing is happening on every level, in every market, and every day at the same time. So instead of looking at the markets as some big scary thing that you have to try and figure out, literally just break it down to its core elements and simplify it, and it will make things much simpler. So probably familiar with at least one, if not multiple, of these traders here, or different concepts. So you got your ICT with your power of three: accumulation, manipulation, distribution. Steve Morrow with the market maker cycle and the EMAs. Stacy Burke, pump and dump, smart money concepts, supply and demand. All of these styles of trading, people are going to be getting in to the same moves. They're going to be focusing on the same time of day, same kind of price levels, just slight different nuances. So instead of thinking that they're all different, they're actually all the same concepts, just speaking slight different lingo, different perspectives. As I said, perspective is everything. So ICT's perspective is going to be slightly different to Steve Morrow's perspective, even though they're both going to be selling the midweek reversal, if you know what I mean. Or Stacy Burke's got his 12 candle window, ICT's got his kill zones. You've got your level 3, that's ICT's distribution. All the same thing. And obviously I just included a little BTC chart down below just to kind of, because I know everyone's seen this. This is all that's happening on every level that just looks slightly different. So price will have a big impulse move up, pump, trap traders, so this wick here is the trap, and then dump back down. So up by the escalator, down by the elevator. So probably all really familiar with seeing something like this or something to the same effect. This is what's going on. Yes, we know, but what I really want to do here is actually simplify things down even further. So instead of looking at this and trying to figure out all the little different aspects, just want you to imagine the market is just going up really fast and then down really fast. So what we basically have to do is just outline the pump. So the pump being this point here, wait for it to be locked in, that's the peak formation. So wait for volume to be trapped up top, so everyone's long, boom. Once we pull short, trap them in, they're now trapped. Let price trade back into it. Oopsie daisy. So let price trade back in and then trade away. So what we're looking for is basically price to pump up, trap volume, and then come back. So we can be taking this point here where there's the trap volume here, this trade here, or else this trade here. Both are pretty much the most optimal trades. So if you're talking about Steve Morrow, these are your safety trades, so your ID50, your 50-50 bounce, ICT's optimal trade entry, Stacy Burke, pump and dump. But basically, yeah, just gonna want to break this down and show you how they're all the same thing, and how you can actually just be training your eye to look for one thing in the market and then just scale that up in size, and then just have that as your bread and butter. You know it inside out, and you're not afraid to lump on when it shows up. That way you can really, really make significant gains. Like, we don't want to be risking 1% for every trade. When we're at this point in the market, we can be lumping on heavy and then writing that down, because we know where we are. It's not just gambling, we know where we are by the behavior. So we're not trading patterns, picture patterns per se, we're trading actual trading conditions or actual behavior. So this is a week, as you can see, playing out. So we have the pump here, pump up, peak formation locked in, price comes down, mitigates this without taking it out, back up, and then the second dump. So this point in the market here is actually my favorite point to trade. Once the high has been locked in and we're trading back into that level. Exact same again. This is actually pound Swiss this week. So beginning of the week pump, peak formation put in place, above round numbers, not relevant right now. Comes back, mitigates, but does not take this low out. And then we're just looking for sell high opportunities, because the high's already locked in. We're now waiting for price to pump up so we can short it back down to the low of the week, to the dump. And look at these guys, they are literally, looking at them, and the reason I really hone in on not trading picture perfect patterns is because not everything is going to look the exact same. Whereas if you're trading behavior, then it doesn't matter what it looks like, you're just looking at what's actually going on, and you can trade any kind of conditions. So you can transfer this over to any kind of market conditions. So as we can see here, these don't look the exact same, but the exact same thing happens. So they don't need to look identical for them to be identical, in a sense. So beginning of the week pump, beginning of the week pump. Peak formation locked in at numbers, peak formation locked in at numbers. In the last video I covered different types of peak formations. So this one's obviously a double top, this one's a triple top. So mitigation of pumped, pierced numbers, and triggered breakout orders. So mitigation of pump, price mitigates the pump there. So price, you can see here now, this is why this difference is important, because this happened on the Thursday. Price pierced below the numbers, tagging in institutions, and then closing back up again. Oops. Whereas on this, it happened on the Tuesday. So it's the same behavior, but it's happening at different points. It doesn't make any difference. But if you were trying to trade something that looks the exact same every time, then you're going to be at a loss if it happens on a Thursday and you're thinking, okay, well, this should have happened on a Monday, or this should happen on a Tuesday, etc. Then we get big pump up and then a dump. Same again, pump up and a dump. So comes up to round numbers, pierces above, it's the 50 line there, closes back below, comes up to round numbers, 50 line again, back below, douche. So this is it now on a monthly fractal. So instead of being days, these are weeks. So big pump up, week 1, week 2, week 3, mitigates, doesn't take it out, and then follows through. So then this is your dump, dump. So applies to any markets as well. So this is a Bitcoin chart. You can see pump, comes back down to mitigate, doesn't take it out, and then dump, pump, up, comes back down, mitigates, and then dump. Any time frame as well. So this is a gold chart. So we can see here, pump up, comes down, mitigates, back up again, dump. So this is actually, look, the same trade, just different. See, look, April 14th, same trade. Oops. But you can see it happening on a fractal level. So here's our initial pump, boom, boom, boom. And then look at this as well. So then just even in the New York session, we have the same pattern playing out. So you can see the minute it kicks in, look at this, like we're waiting for that, a gap in the market, impulsive move. Traders are lulled in the opposite direction, you might get just choppy, doing feck all, and then boosh. That's what we're looking for. This is what once price comes up here, this then is our point of interest. We have to return to here. There's an imbalance in the market. There's an order block there. There's liquidity there. There's a bunch of shit there. No matter what kind of language you're talking about, price has to come back to this point, and it does so in a certain manner by locking in a high, trading away from it, mitigating positions, creating false sentiment, mitigating the above orders, and then trading down. It's the same thing happening everywhere. So price, boom, pumps up. So even in the London or in the gap time, pumps up, locks in a peak formation at numbers again still, comes down, mitigates orders, boom. This is key point of interest, the order block or the supply zone that caused the break of structure. So you can either trade away from this, or else you can wait for that to get locked in and close below numbers, as I did here. Either way is okay. You can do one order here, one order there, scale up in size, pardon me. Whatever your risk appetite is, you can have an order set here with stop above there, or else you can wait for it to break down. Depending on your trading style, your personality, etc., is how you can want to treat that. So as I was saying, as long as you know what conditions you're trading in, then you can anticipate what type of behavior you're going to expect. So we have the big pump here, big formation locked in, price trading into it, mitigates, pumps back up, and then we get the dump. So on a day like this, price is just ranging. You might not know what's going on, but and then once price takes out this low and pushes back up again, you might be thinking, if you're sitting there just trying to trade the direction, you're not going to have a clue where price is going to go. Is it going up? Is it going down? Like, you're not going to know what the crack is. But if you know that you're literally in the range expansion phase, waiting for the dump back down, then any pump back up is actually, you start licking your lips as opposed to shitting yourself. You don't get scared when price comes. Scared. You don't get. You're not getting shook as price is coming against your directional bias. Let's say you're actually getting more excited because you're getting a better entry. So as price pumps up, every pump you get back up again. This is a pump and dump on a fractal level. So this is the same thing happening. Every pump back up is just you getting a better entry. So, as I said, yeah, as long as you know the conditions, you can anticipate what type of behavior to expect. Pardon me. And the importance of this is because every trade isn't the same. Look at this week. Obviously, this was the weekly switch over. This was a gap. I don't know what the hell was going on there. But out of every move in the week or every session, look at this. Like, there's chop, 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 chop. Like, there's only certain moves that we actually want to be in the market. And there's only certain, and like every, for instance, like if you look at the New York sessions of the week, you cannot put serious size on a lot of these trades. So for instance, this one here, this is a pump and dump. If we're looking here, pump, comes back down to mitigate, high locked in, boom, dump back down. So there is a point where you can actually scale that trade up in size. However, it isn't the trade for the end of the week, if you know what I mean. Trade back to the low. This one, on the other hand, is scalable, and you can keep adding to it as price goes down, because the further down it breaks, you know where the target is, so you can keep scaling in. And I guess the point I'm trying to make is that you need to know market conditions to know how big you can go on the trade, on your size, and how long to hold it for. Because if you're just trading a pattern, for instance, per se, you're not going to know when, just say you get a pattern entry here, this could be, you might just be going for your 50 pips because that's what your strategy is, for instance, but you're leaving all of those pips on the table just purely because you're not aware of what conditions you're in. You're in range expansion conditions. I'll go through these on a different video. It's there's obviously variations to the theme. So we're getting pump and dumps. Everything's a pump and dump. Imagine that. Just switch your market view to being lots of different ups and downs and just to everything is a pump and dump. but then there's slight variations on that theme. So at the minute, you're getting in somewhere in a pump and dump, but you might not know exactly where per se. So basically, just what a good exercise could be is just to go through your journal and figure out which part of the pump and dump are you actually getting in. Are you getting in on the pump on the way up? Are you a breakout trader who's once price breaks above here, you're getting in there? Then you realize, okay, I'm actually getting in on the start of it. Are you a market maker trader who's getting in on the first pullback to the water, the 50 EMA? You're getting in on the level 1, etc. Figure out where it is, and then figure out which stage you want to be getting in. So do you want to be getting in on level 1, or do you want to be getting in on level 3? Do you want to be getting in? Pick the point that you would like to be entering in the market, and then basically just work backwards. So by that I mean just look left. And obviously this is fractal, so it works for every trading style. So as we can see, like if you're a monthly trader, or sorry, a swing trader, this pump and dump is happening on the monthly, so you can be literally waiting for price to break down below here, mitigate, waiting for a pump. What do we say the key points were? Swing lows or order blocks that broke structure. So this was the order block that broke structure, this was the swing low, waiting for price to come up there, and then you can hold that for 1, 2, 3 weeks of drop. Or conversely, you can be an intraday trader and just load the boat on this one banker setup. So this now is a breakdown, or basically at the weekend on Sundays I will do up my market analysis for the week. So what trades I'm anticipating to wait for the week, because what I say, plan your trades and then trade your plan. So I'm not coming to the screen trying to figure out whether price is going to go up and down, bearing in mind this is on a picture perfect week, so everything I'm saying here is me also talking to myself. So this is like education for me also, like basically telling myself to do this. So on a perfect week I will sit out there on a Sunday and plan out all my trades. Obviously life gets in the way a lot of the time, but as traders we should always be striving to, like, this is a performance sport, if you want to call it that. But so we have to be operating at peak performance. So the most optimal thing to do is on a Sunday to go through all your pairs, whatever pairs you're watching, and get a higher time frame bias, and then basically just break it down further and further so you actually know what you're looking for on a day-to-day basis. So this, as you can see here, is July 17th, so that would have been a Sunday, and I'll go through and explain what happened. So as we can see, what I'm trying to do is just look for the pump. Okay, so here's the pump, there's the pump, peak formation locked in, broken down. Now what are we anticipating? Mitigation of the order block that broke structure, and then a dump back down. So as we can see, so here we are at the mitigation stage, so we needed price to come back up, to come back down. As we can see, that is what happened. You can see, so July 24th, so July 17th, July 24th, July 17th, July 24th. So this is Pan Swissy. So pump, price dump back down. So what stage are we at here? Price is just about to mitigate. So after that we anticipate price to come up, mitigate on the sell side, and then continue down. So price, yes, tag the zone, came up, mitigated in the sell side, and then continue down. So this is now Pound Aussie. So this one now is slightly different. So price pumped, locked in the high, came down. So we'd already mitigated here. So we'd mitigated, come back up. Now we're not anticipating price to come the whole way back up here, because we've already done the mitigation. We've already created the false advertisement. We've already whatever you want to say it. So now we're just anticipating a clean fall, and price then just fell the whole way through. So we were at a different stage. We were experiencing different market conditions. So it's important, as I said, to know whether or not we're anticipating a big push up, just so we can know where we're at. Are we anticipating one more push back up here, or are we now loading the boat? This one now is slightly different. So what I will say is, like Stacey Burke, I am definitely a bear. I can just visualize shorts so much better than buys. I don't know if it's like psychologically it's easier to imagine price falling or what the crack is, but my eyes have been trained. That's probably what it is, to be fair. My eyes have been trained to spot this on the short side. So as you can see, this is actually a reverse. So instead of a pump and dump, this is a dump and pump. So we can see here, last week, 2 weeks prior, we dumped, put in the high, or sorry, put in the low. I've been saying it the wrong way. Put in the low, come back, mitigate. So now there we go. So last week we mitigated this position here, but we didn't take it out. So what are we anticipating? We're anticipating to finish that off and then obviously complete the cycle in the opposite way. So then here's our pump. So once it happens on the sell side, it then occurs on the buy side and then back to the sell side. So as we can see, exactly there. And then look, it even played out, boom, pump. So we finished off this dump and then pump and then started a new pump. Comes back down, mitigates, puts in a high, comes back up here and then short. So this was the trade that I called out, that I broke down in the video. Was this trade here, this short. I then shorted this again the next day. But again, like I mentioned before, did not even take my own advice and didn't hold it the whole way. Once it mitigated somewhere down here, I closed again, leaving lots of profits on the table. So it's just about realizing where you are in the market and just taking that, or just like running that up to its max. Absolute shit example there. Shit choice of words, but you know what I'm trying to say. So going forward, I would suggest to just pick a part of the pump and dump that you want to master. So pick the big boy run. Pick the, let's go on to a week. Pick the big moves. Pick the one that moves fast and hard, because they're going to be the least stress trades. Obviously, if you're for buying or whatever whether you can only trade London, you can only trade New York, whatever it is, just pick a part and then master that. So find it on the chart and then work left. So start asking yourself these questions. So you don't need to go through anyone's concepts. You can literally be your own teacher. Like, just figure out, okay, so this is the move I want to be in. What the fuck happened before this happened? So next time it happens, I can be in it. So what happened in the hour leading up to it? Was it a stop hunt? Was price creeping in the opposite direction? Were we at round numbers? What was happening? What did the day before look like? Was it a trending day? Is it a consolidated day? Did it put in a high, put in a low, and then trap volume inside? What was going on? What were the conditions the day before? Not what did it look like, what were the conditions? I should probably change that. So what hour does it most commonly occur in? So are you going to be getting it at the London Open? Is it in the Stock Exchange Open? Is it in Equities Open? Or is it in the final hour? Is it coming into the session close? When does it happen? So then you can be ready for that. And then basically, as time goes on, just lower and lower your screen time. So you're only on the charts for the hours where you're anticipating this move. And then everything else is just noise, because everything really is noise. All you want to be in is those moves. So figure out all the little nuances, work on this, and then simplify it down. So that's really just getting rid of your screen time. So just, obviously it's going to take a lot of screen time to figure out all the different characteristics, but once you have it, simplify it down, strip everything off your charts, just have your round numbers or whatever, just your major price points that you're looking at, outline your pump, anticipate your dump. So all you need is one setup. As I said, when this shows up and you have looked at it time and time again, and it's not like, oh, I've seen an M before. It's like, I have seen this market conditions before. I've seen the trapped volume. Okay, so I know that they've gone up Monday, Tuesday, trapped volume above the double zeros, pulled back inside. There's now traders trapped long. Okay, so then we break down even further, fast and hard. This is like level 1 behavior, or this is price is now trapping volume further. So if we then now start pushing up, coming into the hourly rotation at round numbers, and then begin to break down, this trade is on. So when this happens, I'm not going to risk 1% because this trade has been building up for the whole week. The volume has been trapped all week. I can see the vectors down there where I'm targeting. I am going to put on 5 to 10% of my account on this. And believe me, you really, really can run up small accounts with this. Like, you can eat off of a £1,000 account. I was eating off of a £500 account just because, as I said, when the setup is there, you can load the boat. But then, obviously, as trading is, you get too confident, you start making lots of money on that particular setup, and then you come back from the gym, or you just load the boat on random setups. That is what needs to be addressed. Is like, you can't just risk 5 to 10% on any position, on any, like, even if it's lining up with some of your confluences, you can't just load the boat on those setups because it has to be a specific one. So yeah, that's pretty much it. Just find which point of the pump and dump you're in, because you're going to be in some point, because as we can see, it's in every market on every time frame and since the dawn of markets. So figure out which point you're in. Are you in, let's go back to start. Are you in the pump phase, lock it in the high, the dump, mitigation, so are you counter trend trader, or are you in a final product? Which one is it? Pick it, or if you have it already a spot, if you want to adapt it, pick a new point, and then just, yeah, as I said, just work backwards, study that, just that, simplify things, and yeah, just load it up. So that's it from me. Hopefully this provided some value. I don't know. Hopefully it wasn't too confusing. But yeah, that's pretty much it, guys. Just chatting shit now, so I gotta end this. Have a good one.